All right, welcome everyone. So what we're going to be looking at today is going to be two things. The first thing is going to be understanding timeframes. You must understand that the market moves in timeframes. The time frame you're studying the market from matters a lot, right? What are you seeing? It enables what you see, because you want to be able to see the market from certain time frames to give you certain clarity as to what the market is supposed to be delivering to you. What is the market doing? Okay. What is the market doing? Time frames enable you to see that. Also, then the next thing we're going to be talking about is going to be identifying some chart patterns. Some basic chart patterns that we need to take advantage of to begin to make profit from the market. So let's start with time frames. Now, when you look to the top of the screen here, you will see that there are different time frames. You have the M1, M5, M15, M30, H1, H4, D1, D1, W1, MM. Now, these are time frames by which you study the markets. Now, every candlestick you see on this chart was formed in a certain time frame, and that determines what determines the time frame, what determines the way the candles are formed is the time frame you're logged into. Currently, we are on the H1 time frame. H1 time frame. Now, if we switch to a different time frame, you discover that there's a bit of a change in what you're seeing on the screen. This is the H1 time frame. This H1 time frame gives you a certain picture of the market. H4 will give you a certain picture of the market also. And then the higher you go, the clearer it gets. The lower you go, the more cloudy it might get. So now you have different time frames here. So we're on the H1 time frame right now. Typically, when you want to see the market very clearly, you use a higher time frame first. It doesn't mean you have to trade off of a higher time frame. It just means that you need to use it to see the market. Time frames are very, very important. Okay, you need to use it to see the market. Now, you may not understand what the market is doing if you don't use the right time frame. Time frame is like a lens you're using to view the market, because everything you're seeing on this chart is basically historical chart patterns, historical price patterns, right? Historical price patterns. That's what you're seeing here. That's what's being printed to you in a candlestick. So the way you're looking at them is very, very important. Okay. So that's it. That's when you look at time frame. Now, when you look at this time frame, this is 1 hour. Let's go to, let's say, 5-minute time frame. Now you see that the market is trending downwards. The market is coming downwards. You can see from this top here, all the way to this down here, that is price heading downwards. That's price heading downwards. Now, let's try and go back a little bit and try and see what's been happening for a while. So look at this. At this point here, at this area here, price was making an uptrend. So this class is not really a class where we go deep into trends, okay? On a different class, we'll do that. But time frames, I want to just point to us to here that time frames matter where you are seeing the market from, right? Now, if you're looking at this, you can see how price is moving all the way down. Now, if you go to a higher time frame like H04, market is still moving down. When you go to a time frame like D1, the market is moving down, but you will see what's been going on for a while. You'll see what's been going on here. You'll see that, yes, while price has been trending downwards, very recently it was trending upwards, before it turned down again. Now, if you're on the trade here, that right now you're on a trade here, and you are running this trade down for a sell, you would expect that this sell trade, in my opinion, this sell trade is still going to come all the way down, likely going to come all the way here. So from here to here, is price still going to drop down? This will help you to see, oh, what is happening in the market. It's not just the 5-minute chart you are seeing, where you are beginning to think, okay, oh, I don't know what's happening. But when you see it from a larger time frame, you know what's happening. You're able to see what's happening overall. Then, if you want to trade, you can then decide you want to trade on lower time frames. Decide to come and trade on a lower time frame, right? Okay. I hope we're understanding this, because this class seems like a class for a higher, seems like it's not a beginner class. All right, now let's quickly look at something else. And that thing has to do with chart patterns. And what do we mean by chart patterns? Now, when you look at the market, there is a way the market plays out. There is a way that the market moves. Now, remember, guys, what we are doing every time we are trading, what we are trying to do is that we are trying to use what has happened in the past, what has happened in this market in the past, to predict what is going to happen in the future. We are trying to use what has happened in the past to decide, to predict, to help us get a picture of what is likely to happen in the future. That's what we're trying to understand. So whatever it is that has happened in the past, because in this market, what has happened before repeats itself again. History repeats itself a lot in the financial markets. History repeats itself a lot in the financial market. So because history repeats itself a lot in the financial market, what we are looking at is what is it that has happened in the past that's likely to happen again. Okay? So I'll quickly look at this as it's slightly not long. But look at this. Let me put something here, and then let me try to at this area marked now with green. Look at this area marked with green as well. So there's a pattern we call the head and shoulder. There's a pattern we call head and shoulder pattern. There's a pattern we call the double bottom and double top. Double bottom, double top, head and shoulder pattern. Double top, double bottom, double top, head and shoulder pattern. Okay, so I'll look at this. I'll make us a little note so that we can understand what we're saying here. Now, this is what a double pattern looks like. So let me give us a bit of an explanation here before we come to the chart itself. Okay. So the patterns we're looking at here, we are going to discuss a couple of them. Number one, we call the double top. Double top. Number two, we call the double bottom. Number three, we call the head and shoulder pattern. Number four, we call the inverted head and shoulder pattern. Inverted head and shoulder pattern. Okay. We have a double top, we have a double bottom, we have a head and shoulder, we have an inverted head and shoulder. Now, when it comes to the double, let's try and make a little note of all of this. For the double top is a bearish signal. bearish chart. It's a bearish signal. Double top is a bearish signal, which means that it signals a sell. It signals a sell. So I will show us this on the chart so that we can understand what we're talking about. A double pattern, anywhere you see a double pattern is a signal for a sell. It's telling you is a high probability that price is going to sell from that point. Then a double bottom is a bullish signal. It signals buy, signals a buy. A head and shoulder pattern, is a bearish signal. Bearish signal. Bearish signal means that it signals bearish signal means that it signals a sell. Signals for a sell. Signals for a sell. Why the inverted head and shoulder pattern is a bullish signal. Is a bullish signal. It's a bullish signal. Sorry, guys. There's a call that's coming in. I'm not able to shut off the call. So an inverted head and shoulder pattern is a bullish signal which signals a buy. Which signals for a buy. Right? So these are 4 simple patterns that we're going to talk about today. And I will basically show you how they look on the chart. Right? So before we do that, let me start by illustrating. Now, let's look at this. Price moves like this, like this, like this. It keeps going, it keeps going, it keeps going. Then it hits this point, and then it starts to come down, starts to come down, starts to come down. And then at a point, it reverses, it starts going up again. Now it gets back to this top. You see this? You see this area here? Price gets to this top and reversed initially, right? Now, suddenly, when price gets to this area again, you start to see it getting ready for a reversal again. In which case, you are expecting to see price move down this way, like this. Now, it doesn't mean that every time price moves up, comes down, then gets to this point, is going to start selling. No, doesn't mean that. If price is in a serious bullish move, like gold has, like we've been seeing in gold, price is not just going to start selling because he hit he hit an area where it had hit before. No, this is what we call a double top. So a top was formed initially. Price hits that top for the second time, and what happens is that it collapses and sells from there. it collapses and sells from there. That is a double top pattern. Now, like I said, you do not just see a top and then when price hits that top again, hits that top area again, like this, you mark this area now like a top, and then once price hits that top again, you expect it to sell. You expect it to sell, but you do not just place your sell immediately. You don't put your sell immediately. What you do, you don't place your sell immediately once price gets here. What you do is that you wait for price to come down. You wait for price to give you the signal that is doing what you're expecting it to do. So in the market, you are meant to have an expectation of price. What will price do when price gets here? What will price do when price gets to this point? What will price do when price gets to this point? That's what you're supposed to have an expectation of. But you don't just jump into the market because I'm expecting price to do this. There's something that is said in trading that is very important. In the market, you trade what you see, not what you think. In the market, you trade what you see, not what you think. So this is a top here. We call this area stop, where price rose to and then reverse. That is a top. When it comes to this area now, we call this a bottom. This is a bottom, this is a bottom. Where price dropped to and then reverse, that is a bottom. When price rises to a point and reverses, that is a top. When price rises to a bottom, when price drops to a level and then reverses, that is a bottom. Let me say that again. When price rises to a level and drops, that area forms a top. That area where the drop happened. It rises to that top. From that area where price changes direction and starts coming down, that is a top. Once price now comes down to a certain level and reverses, that area is a bottom. Okay. Now, we also call these swing highs and swing lows. So we call it high or low, swing high, swing low, top, bottom, they are the same. Swing high, swing low, top, bottom, they are the same. Now, when price rises again to this level where it had formed the top before, okay, your expectation is that price will start to dip. You start to sell from there. But remember, you don't trade expectation. In this market, you do not trade expectation. You trade what you see, not what you think. So what does that mean? What does trading what you see mean here? It means that when price hits this level, what you are going to do is that you are going to wait for it to give you a signal that it's about to sell. Because price can get to this point and you're expecting to sell, I will just break out and start going up. That happens. Especially, like I said, gold. Now, go and look at gold. Gold has been, there are areas where you expect gold to sell and it just keeps buying. Not that it may not sell, it won't still sell, but it may not sell when you expect it to sell. It may not sell when you expect it to sell, and that is not good. You don't just jump into the market and say, okay, eventually it will sell. You may not, your capital may not be enough, your balance may not be enough to carry that drawdown that will happen when it goes against you before it starts coming down. Your account may not be able to carry it. Your account may not be able to carry it, right? So what you then need to do in order to avoid such situations where the market goes against what you expected to happen is don't trade expectation, right? Instead, have an expectation, but let the market give you a signal that that expectation is right. Have an expectation of what you expect the market to do, but let the market give you a sign that that expectation of yours is right. So how does that look like here? What that looks like here is that once price rallies to this point now, it will give you a signal that it's about to buy. It's about to sell because you're already expecting price to sell. It will give you a signal that it's about to sell. So what happens then is that becomes your confirmation that you should be selling, right? Because the market gets to this area, you're already thinking because price is getting to the same high it has pulled back from before. It has sold from before. Now it gets to that high again. When it gets to that high, you are expecting a sell. And since you're expecting a sell, you don't just sell immediately, but now you're waiting for price to confirm to you that it's actually going to do what you expect it to do. So you wait. And then price actually drops down to a certain level, telling you, confirming to you that it's about to actually do what you expect. Then you jump on the sell trade and it's going to be very, very good for you, right? This is how this works. This is what we call a double top. That's the reason why I say it's a sell signal. You said it's a bearish signal. A bearish signal means it's a signal to sell. This is why it's a signal to sell, right? Okay, so let's look at the buy side of things. Let's look at the buy side of things. Now, that's for double top. Now, the double bottom is basically inverse of that, right? So you see price move all the way down to this, to a level. And then what happens? Let's do this again. So price moves to a certain level. And then what happens is that you see that price starts going up. Okay. And forms what? It forms a bottom. Price moved down, forming a bottom. What did we say before? We said when price moves sharply down or moves down and then suddenly reverses, that area of reversal is what we call a bottom, or we call it a swing low. We call it a bottom or we call it a swing low. So that is a significant point. It's something to watch. Literally, you need to put like a line there or a marking of some sort there to tell you something is happening here. There's a reason price moved and changed direction. Whenever you see price change direction or price make certain moves, understand that understand not to take it lightly because it takes a lot for price to make certain moves, or price to make any move, in fact. So when you see a significant sharp move, it tells you something. Okay. So price moved from the top to this bottom here, forms the bottom, and then moves up. Once price starts coming down to this level again, this is where you start to watch and say, okay, this is a bottom here. This is a bottom. So is price trying to form another bottom here? So maybe price is trying to form another bottom here. So if price is actually trying to form another bottom here, that means I'm about to make a buy trade. That means this is a signal that the market is likely going to buy. You would have seen this. This is a signal that the market is about to make a buy. But like I said earlier, you don't just jump into the market and buy because you expect a buy trade to happen. You don't just jump into the market and buy because you expect a buy trade to happen. You need price to make a significant buy. You need price to push up from here. You need price to push up from here, signaling to you that your expectation is right. You're already expecting price to buy from there, right? Because it's a low. Okay. Now, when you see price sharply move up, that is your signal. Oh, yes. Now, that means I am not the only one seeing this thing. The entire market is seeing it. There are lots of people, lots of traders who are expecting the same thing I'm expecting. So once they are expecting the same thing I'm expecting, that means they are going to be buying. Just the way I'm looking to buy, just the way I'm buying, other people are buying too. And that buy, that cumulative buy by a whole lot of us is what is driving the price of the instrument up, or is what will drive the price of the instrument up, right? Is what will drive up the price of the instrument. So I wait to see a signal, giving me a signal that price is about to buy, then I jump on the trade and for a buy. This is what we mean by a double bottom. A bottom that forms a bottom again. All right. So this is a double bottom. So let's do the third thing. Who is marking my screen, please? Who is marking my screen? Please stop. Thank you. Okay. The third thing is what we call a head and shoulder pattern. A head and shoulder pattern. So the way this works is this. You will see that price is buying. You see that price is buying, which means it's rising. You see that price is rising. It hits a level, then you see it coming down. You're like, okay, let's see what happens. Then it stops and starts going up again. Starts going up again. Then it hits this level, which is the previous high. And like, okay, what's going to happen? Is it going to sell from the high? No, it breaks past the high. It breaks past the high. And then you're like, okay, that means it's going to buy. Okay, oh, very nice. This is a buy signal. So let's get ready. Then guess what? It hits somewhere and you are expecting it to maybe start buying, but instead it keeps selling. It sells and sells and sells and comes all the way down. Start dropping. You're like, what's going on? Then you see. Then guess what? This is the look at the left. This is the left shoulder, the left side of the market, which is the left shoulder. Then the top there is what we call the head. Then that means when you can see a left shoulder, see a right shoulder. You can see a left shoulder, see a head. That gives you a signal that probably a right shoulder is about to form. So market moves like this, hits this level somewhere here, and then starts coming down. So this becomes your left shoulder. This is the head. This is the right shoulder. So once you see the head, once you see the left shoulder and the head, what you are waiting for is just the formation of the right shoulder. The right shoulder is your signal for a sell. That's why we say that a head and shoulder pattern is a bearish signal. It means that it's a signal for a sell. These things are all over the chart. You see them periodically. You don't, not like they happen every day. You see them periodically. So what you have to do then is observe them so that you can take them to trade. Observe them so that you can use them for your trading, because they can be very, very profitable patterns to trade. As I see right now, there's one instrument I watch and I trade where this pattern is playing out so well as we speak right now. It's playing out so well. I've seen it since probably a week now or so. And then today now it's been gradually coming down, and today now is just selling heavily. And that's because of the head and shoulder pattern. Because you are not the only one thing you have to know, guys. You are not the only one who is seeing what's happening in the market. A whole lot of other people seeing what's happening in the market. To an extent, the market is a self-fulfilling prophecy. You are dealing in the market, you expect certain things to happen. You are seeing the market, you expect certain things to happen. I am seeing the market, I'm expecting certain things to happen. Right? So because I'm expecting it to happen, I take certain actions because of what I expect. You take a certain action because of what you expect, and the market starts to play out in our favor. So it's more like we are the ones making our dreams happen in the market. Okay, that's a head and shoulder pattern. Then the inverted head and shoulder pattern is just the opposite of this. The opposite of this. Okay, let me just mark that off a bit. So you see, the way that works is this. You see price comes down, it's coming down, stops. Then it reverses, it starts going up. Then it stops. then it comes down. You are expecting that because there's a low here, it is going to hold at this low and start going up. But instead, it breaks out of the low, breaks the low, comes down. And then once that happens, you are thinking, okay, now it's going to sell. Instead, it goes up. And it forms a right shoulder. So inverted, it forms an inverted left shoulder first. And once you see a head, that is your signal. Okay. Sorry. Okay, see what I'm trying to do here. Now, this is the left shoulder. This is the head. Once you see this, you know that a right shoulder is about to be formed. Once you see this, you know that what is left is a right shoulder. A right shoulder is going to form somewhere around here, right? A right shoulder will form somewhere around here, somewhere that matches the left shoulder, somewhere there. It's not perfect. Sometimes it's not perfect at all. Now, you can see all of this popping out. Sometimes it can be like that. Sometimes it can just hit this level, and then what you are now expecting to happen is price moving upwards. That is the bullish move here. That's why we say inverted head and shoulder is a bullish move. We now expect price to rise up from there. I hope I'm taking note of this. So let's quickly go into the chart. Let's see what we can find. Now, from the first one, the double bottom is what you're seeing here. You can see price came all the way from the top here, came all the way down. What happened? It started going up. Once it got, well, then it started coming back. Then it hit this level and then gave us a signal that it's about to buy. This is a signal. This is a signal here. This candlestick, this long candlestick here, that is our signal that price is about to buy. And immediately that signal was formed, price did what? Shot up. It didn't shoot up immediately, but it still shot up very heavily. If you had gotten on this trade from where? From here, this would have been a very profitable trade. This is how many pips. This is 107 pips. 107 pips. From after this signal formed, you get on the trade 107 pips. That's really good. That's really good, right? That's a double bottom. Now let's see if we can locate a double top here. So I would consider this to be a double top. So I'll consider this is a top. Okay. Then this is another top. And from what you can see, they are in the same exact location. So price moves from this bottom here, that hits this level, and then turn back. And then price comes again to that level. Remember, we said something. Once price is doing what you expect it to do, you don't just jump into the trade. You don't just jump into the trade. No, you're expecting price to sell, but you don't jump in. You wait for it to start coming down. What happened? It gapped down, went up a little, and then started selling. After this gap down, it went a little. Let me tell you, look at where the sell signal was. This area here. Let me see. Let me see and delete this. This is the sell signal here. This is where you would have entered the sell trade and ride it up and read it on down here. And you can see it's still selling. Up to now, it's still selling. Still selling. This is USD CHF. This would have been the signal for the entry. And up till now, price is still selling. Okay, that is a double top. A double top. These are things that if you sit down, you will understand it. That's why we say that in trading, 15% is what you learn, 85% is what you do with what you learn. When you sit down on your chart, you will see that these things are so simple. You're like, wow, wow, I've never seen this before. Wow, wow, wow. And it will start playing out the way you expect it to play out. And you will see it in different places. And there is no right, notice one thing, guys. There is no right way to see this and the wrong way to see it. There's no right or wrong about this. There's no right or wrong. There's no right or wrong about this. When you understand it, you realize that it can play out a little bit differently here and there, but it's the same thing, basically the same thing. So you want to make sure that you are paying attention and then you practice it. So you don't practice and say, oh, I did it like this. I'm not sure if I'm right. There's nothing like right or wrong. All you just need to do is reinforce what you know by going over and over. If you see it here, can we go and see it elsewhere? Can you go and see it another place? Can you go and see it in another place? Can you go and see it in another place? They are all over the place. See? They're all over the place. Right? So now let's check then another one. This is NZDCHF. So NZDCHF was an instrument that I have been expecting that NZDCHF is going to sell because, like we said earlier, the time frames you're looking at the chart for matters. So I looked at NZDCHF from a higher time frame, and it gave me an idea that NZDCHF is about to make this sell. But what did we say? You don't just enter the market and start selling because you think it's going to sell. Because whatever you don't see is happening inside your mind. It's you thinking about it. So make sure that you are not just thinking what you are thinking, you are actually seeing what is the market is showing you. So don't trade just because you think something is going to go well, or your trade is going to go well, or price is going to go your direction. That is not good enough to trade. What you want to do is that you think this thing is happening, or this thing is about to happen. You wait for it, you wait for a confirmation that that thing is about to actually happen. You wait for a confirmation for that thing to happen before you jump into it. If you don't wait for confirmation, you lose a lot of money. Okay? So you notice something here. You notice there's a head here, sorry, a shoulder. Then there's a head. Hold on. There's a shoulder. This is the head. This is a shoulder, the right shoulder. This is a left shoulder, a head, and a right shoulder. And price collapse. This is what we call a head and shoulder pattern. A head and shoulder pattern. So you see, this is something you notice carefully. For me, I've been seeing it. I'm like, oh, this is a head and shoulder pattern forming. This is going to be a sell. Can you see how it has sold from here now? Easy sell. Easy sell. And you will see this in many, many, many instruments in the market. So you will know. You are not an expert, but you can see this is head, left shoulder, head, right shoulder formed. Oh, was right shoulder formed? That is my signal to enter my sell trade. All right. Now, guys, you are going to go back to your chart and you are going to practice these things. Look to your chart, look for it, take screenshots, send to the group and say, this is what I have done. Correct me. That's what you need to do. Okay? Now, this is head and shoulder. An inverted head and shoulder, I'll try to see if I can find that. I will consider this to be an inverted head and shoulder right here. That's why I said I didn't look at this before. This is the one I've seen before. Now I didn't look at this before, but I can easily see it here. Okay. So I can see that this is a left shoulder, inverted left. I can see that this is a head. I can see that this is a right shoulder, and price went ballistic. So this is what we call inverted head and shoulder. The other one is a head and shoulder regular because your head starts on top of your head. Your head stands erect, stands straight, and then your shoulder is on the left sides of your head. That's why we call this head and shoulder. Then this other one is inverted. The head is on the ground, and then the shoulders are still standing side by side. It's like when you invert something, like standing upside down, that kind of thing. That's what you will see here. Okay. So these are the 4 patterns we're going to study today. And there are a couple of other patterns, but then you need to go and practice this. Take your chart right now. Look for this pattern, these 4 patterns we talked about now. Look for them. These 4 patterns we talked about now. Look at the double top, double bottom, head and shoulder, head and shoulder. Look for this pattern on your chart and mark them so that you can start to recognize on the chart. Okay? Do we have any questions? Who has a question? This is being recorded, by the way, so you're going to have access to this recording. It's being recorded. So I'll be able to go over this again. Oh, does anybody have a question? Does anybody have a question? 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 Basically, if you have a question, that means you probably know this already. If it's the first time of getting to know this, you may actually not have a question. I understand that. But just in case you do, anybody with a question? Anybody with a question? Okay, we'll end the class here. We'll send the recording. We'll end the class here. We'll send the recording, upload the recording, and then post it in the group so that those of you who are here can go over it, and those who were not here can go over it over and over. Right? Thank you guys. I'll see you guys on the next one.